A very good afternoon, good evening to all of you. The speaker for today's seminar is Dr. Poorya Kabir. He completed his PhD in finance from Columbia Business School in 2020. And he is currently an assistant professor in finance at NUS Business School, Singapore. So his research interests are broadly in the area of empirical corporate finance, and also how corporate finance decisions affect the real economy. The paper that he's going to present today is titled Capital Quality, Productivity, and Financial Constraints, Evidence from India. And this paper is co-authored with Syed Mansoori. So we roughly have an hour for this seminar, including question and answers. So let us give 5 uninterrupted minutes to Poorya for introducing the paper. And thereafter, I think we can ask any questions as we go along. Yeah, over to you, Poorya.
Sounds great. Okay. So let me share a screen. Can you see the screen? Mm-hmm. Share the slides? Okay, yeah, we can great. See. Okay. Yeah. Okay, great. Thank you so much for the invitation. Today, I will be presenting this paper called Capital Quality, Productivity, and Financial Constraints, Evidence from India. This is joint work with Syed, who is a PhD student at Columbia University. Okay. All right, so let's get to the paper. In today's paper, we want to study one determinant of productivity. Now, you might be asking, why do we care about productivity? And let me answer this question in 2 different ways. First, at the micro level, we care about productivity because it matters for survival. Basically, a substantial amount of research across different countries and across over different time periods have shown that companies that are more productive are more likely to survive. Okay? And then at the macro level, we know that productivity differences across different countries explains most of the variation in per capita income. Okay? This is something that we care about. In today's talk, I want to understand this following specific question. Does the quality of physical capital affect productivity or not? Okay? And you might be thinking, what do you mean by the quality of physical capital? And let me show you this quote by Chad Syverson from Journal of Economic Literature. Okay? So Chad Syverson in Journal of Economic Literature writes the following. It says basically capital can vary in quality in ways not captured with the standard measures. If capital vintages differ from one another, in how much technological progress they embody. The common book value-based capital measures will tend to miss variations. And this is area desperate for further evidence given its potential importance. Okay? So the idea that we have is essentially differences in quality of capital is going to come from how much technological progress they embody. Okay? And then the question is going to be basically how we are going to go about measuring this. Okay? Right? So prior literature basically shows that capital quality is actually quite important for productivity. It explains a lot of variation in productivity. However, the best evidence that we have comes from looking at the same country over time. So as you can imagine, there will be alternative explanations for this finding as well, if your evidence is coming at the same country over time, okay? Is there a question that is quite difficult to study at the firm level for 2 different reasons. The first one is it's usually we don't have data on capital used by different companies. And the second reason is that even if you have data on the kind of capital and machineries companies use, it's not clear how you want to go about measuring capital quality, okay? So the main innovation of this paper is essentially going about to be about measurement of capital quality, okay? So the first goal of this paper is going to be providing an empirical measure for capital quality. I want to emphasize that we are going to provide one empirical measure. It's not the only empirical measure, but one way of thinking about and measuring capital quality, okay? And then the second thing that we are going to do in the first part of the paper is study the correlation or association between capital quality on one hand and productivity on the other. We want to understand whether more companies that use higher quality capital are more productive or not, okay? Now you might be thinking from the way that I'm talking, and in the first part of the paper, we show that higher quality capital, companies that use higher quality capital are more productive, okay? From this, you might be thinking, okay, it seems that capital quality is good. From the way that I'm talking about capital quality, higher capital quality is good. Why is it then that every company is not investing in the highest quality capital? And this is essentially the second question on the paper, okay? So we want to study one potential explanation, and that potential explanation is going to be financial constraints. We think this is natural potential explanation. Let me tell you how financial constraints is related to capital quality. Essentially, the idea is very simple. High quality capital is more expensive. Okay, so if you want to purchase an equipment that has higher quality, it's going to be more expensive. And to purchase something that is more expensive, you need funding. If you don't have funding, you're not going to be able to invest. Okay. So basically, without sufficient internal funds, firms need external financing. Thus, reduced financial constraints can increase investment in higher quality capital. The goal of the second part of the paper is to understand whether this channel is operational. And more specifically, the second question of this paper is as follows. Does reduced financial constraints increase investment in higher quality capital? If so, does this lead to increased productivity or not? Okay, so this is the goal of this paper. Now,
so well, can I ask
yes.
a question here?
Yes,
I think
yes.
When I read the first paragraph, again, this goes back to the statement: higher quality capital is more expensive.
Mm-hmm.
Somehow I feel like there's something missing in that statement. Some assumption which is missing, because in general, you would say that if firms have reasonably good information about the project they're investing in, they will invest in projects which have positive NPV. It's implicitly, it's almost like you're saying that they may pay more per dollar of capital for I'm not able to separate this from overpayment for capital.
Excellent. Yes. Right. So, I can show you the result, but essentially, this particular story where I overpay if I pay something more expensive is going to reduce. Let's say that I just overpay. I get the same machinery and I just overpay. Then my TFB should be lower and not higher, right? Because I'm paying more for the same thing. It should reduce my productivity and it shouldn't increase my productivity. So the channel that you are talking about should have the exact opposite, right?
No, the other thing, more basic, I don't know this really well, but I think if you have two firms, somehow I think two firms will, regardless of the quality, so long as it's a positive NPV project, they are going to buy or invest. So why would quality make it more expensive? Because I'm not able to see that very clearly, that quality should affect the investment decision.
Sure.
Yeah, because your explanation in the paper is a very brief. That's why I was, maybe some anecdotal or some other evidence which fleshes that out would help. Because I'm thinking just there are two firms. One, how do you control for NPV is maybe another way of framing the same question. Right? Sure.
So this NPV is going to be a bit more complicated, okay? We are not going to be able to directly measure NPV, okay? But basically, if you think about it, the way that we are framing or our findings points to this specific, first of all, points to this specific point, that higher quality investment projects, at least in the setting that we're studying, have higher NPV. Okay, so that's the way that you can think about it, okay? If you, now, it's not super clear why, and you're right, and I'm gonna tell you about, in certain scenarios, you expect this to be true, to be more true, so to speak. I will tell you in a bit why, but I want to clarify one thing. So higher quality capital is more expensive. When we are talking about this investment price, we are talking about the initial investment cost, okay? So we're talking about the cost of setting up a factory, okay? I'm gonna talk about this in the next few slides, but I'm talking about how much money you pay, not to run the factory forward, it's just initially project cost, okay? That's how we're thinking about it. So we are basically thinking about it as, and I'm going to give you an example from a market, but I think it will help illustrate the point, okay? All right. Now, let's get to how we measure this quality of capital, okay? Again, as I told you just now, we're going to measure quality of physical capital, so quality of physical capital, but this per unit cost of setting up a factory, okay? So in this particular example that I'm giving you, there are two companies. Both of these companies want to set up a factory. Both of these companies want to set up a factory that produces steel pipes, okay? Now the company on top, we are going to say has lower quality capital related to the company on the bottom if the company on the bottom pays a lower price. This is the setup cost. This is the initial setup cost of the investment per unit of capacity. Okay, so we are going to say that the company in the top has lower quality capital relative to the company on the bottom because the company on top pays $1 per unit of capacity and the company in the bottom pays $2 per unit of capacity. Okay. Now, let me give you an example from product market, which I think illustrates the point a little bit easier, okay? So, you might have heard of Herman Miller Aeron chair. I think each chair costs about 1,500, okay, US dollar. Compare this relative to a generic chair. I think most people would agree that this Herman Miller Aeron chair has higher quality relative to a generic chair. That's the idea. Basically, once you are looking at the same unit of capacity, if the price of something is higher, it's probably because it has higher quality, okay? Now, you might be doubtful about this particular notion, and the goal of, one way that you can view this paper is basically showing that this is a reasonable way of measuring quality, okay? And one other thing that I want to mention here is that we are basically following the literature in measuring quality, okay? So this way of measuring, so this is, you can think of capital as an input. People have used unit prices of material good as a proxy for quality. The idea is exactly the same. Okay? So if you purchase something that has higher price as an input, that has higher quality relative to something that is cheaper. Okay?
Sorry to interrupt, but I think one thing that will be helpful for you to do, it would be to look at the marketing literature then, because there's a lot of work on the imperfect nature of the relationship between price and quality in the marketing literature. And some of the theoretical work may help you, defend your argument a little better.
Sure.
That's just a suggestion. Yeah.
Sure. Sounds good. Okay. Okay. Now you might be thinking, okay, let's say that this is how you measure capital quality. Well, how is this going to be helpful for the companies? Okay, so this is the idea that we have. You can basically help a company in three non-mutually exclusive ways. The first one is the company becomes more productive. They purchase higher quality capital. Now they need less labor, okay? This is a fairly intuitive idea. I think a lot of the literature in technological progress has been arguing that if you get better quality technology, more advanced technology, you basically substitute for labor. So that's how part of this cost saving can come from. Okay? The second one is that you can produce higher quality output. In this example, you can produce high quality steel pipes, okay? So previously you had a low quality capital. As a result, you could produce low quality steel pipes. Now you can produce higher quality steel pipes, okay? And then the third one is durability, okay? If you purchase higher quality capital, it's actually more durable, okay? So these are the three different ways that we think a higher quality capital can potentially affect firm level performance, okay? Now, by now you might be thinking of a trade-off, which I think was one of the points that Srini was mentioning. How should we think about a trade-off? Because if we purchase higher quality capital, we can purchase less of a higher quality capital because it's more expensive. Basically, for the same dollar value, you can either purchase fewer units of high quality capital, or you can get more units of low quality capital. Okay, how do companies do this trade-off? If you think about the NPV analysis, even if you get high quality capital and your margins go up, because the quantity goes down, it's not clear whether you're going to be better off or not, okay? So we think, and this is again similar to the literature, we basically think that high quality capital enables the production of high quality output, okay? This is one of the channels that I mentioned earlier, but the literature and trade has basically documented this substantially, that if you have access to high quality material input, you're going to be able to produce high quality output, okay? So this is a similar idea. The idea is different in the sense that it is about the capital quality, but people have basically been showing this in terms of input quality, okay, and material input quality, okay? All right, so yes, there's a question by Anil. I cannot hear you.
Anil, you are muted. Anil, you are muted. We can't hear you.
Oh, sorry. Hi, can you hear me?
Yes.
Yeah, hi, Poorya. Hi.
Hello.
Hi. So just a clarification, and I think this got discussed a little bit earlier. But what I understand as of now is that there's a discussion about input and about output. Mm-hmm. So what I'm sort of not clear about is, the process basically which can be captured by the quality of management or quality of the administrative quality of the firm is not kind of coming into picture here. So sure. I can imagine that the input quality does have a positive effect on the output quality, but it's so if you think in terms of costs, it's about how the projects are managed. So that sense of quality of managerial effort is not being captured here. I do see that you have a paper by John Reenan et al. There, but I'm not, I think it's not quite clear like how you capture the idea of the process being affecting this relationship link between input and output.
Excellent. So, okay, so I will show you some reduced form stuff, okay? And then you can have alternative explanations for the reduced form stuff, and that's fine. And I'm going to show you some non-reduced form, I'm going to show you some correlations, and then we can have, and I'm going to try to skip that correlations faster, but then there will be a part with exogenous variation. There, I would show you one evidence in particular that's going to be very hard to explain with your narrative. And I will come back to this at the very end of the presentation, okay? But basically, we are looking at the company, so basically, let me get back to this later, but there is an answer to that question, okay? We are not completely ignoring that question, okay? But I'm going to come back to it at the very end of the presentation, okay? All right. So what is the idea? Okay, so again, there is you can basically buy few units of high quality capital or more units of low quality capital. Now, this hypothesis is essentially something that is similar to the literature. Essentially, the idea is as follows. High quality capital is going to matter more for industries where you want to differentiate the quality of your outputs from others in the same industry, okay? For instance, in a smartphone industry, if you have high quality capital, then high quality capital is going to be more beneficial because this is a place where people care more about quality. Versus for an industry with lower scope for quality differentiation, like bottled water, people care less about quality, so there you want to do more quantity, okay? So what would be the prediction of this particular channel? Prediction is going to be as follows. Firms will buy high quality capital in industries with higher scope for quality differentiation, okay? So this channel that we have in mind is high quality capital enabling the production of higher quality output is going to be more pronounced in industries where you can differentiate your products from others. Okay? Right. All right, so what is it that we do in this paper? We use a unique project level investment data set for Indian companies, okay? Most importantly, we have information on project costs. Okay, so that's going to be important. We know the product that is the result of the investment, for instance, the steel pipe. And we see capacity. What is capacity? Capacity is defined as the following. Maximum level of goods that can be produced under normal conditions. Okay, so this is a variable that is provided by the data set. We are going to use this capacity to measure capital quality. How do we measure capital quality? As I talked about earlier, capital quality is going to be project cost divided by the additional capacity generated in the project, okay? So this is going to be our measure of capital quality, okay? We will refer
to question here,
yes.
Poorya, is I struggle with this, the fact that there are different projects, different companies with different products, they're all in different units, right? How would you address this, heterogeneity, like a pipe, a company producing pipes and a company producing a large equipment, they're very different, right?
Sure.
So do you control for like per unit selling prices on the right-hand side in some way?
Yeah, so basically we have product fixed effect, okay? So basically we convert we basically, both Prof and CapEx come with this product code identifier. We define a product as a combination of a product code and the measurement unit, okay? So, for instance.
Yeah, so I understand that. So one thing that we did, the work that I'm doing, is some of these products, I don't know which, there are multiple product names, just a minor technical detail.
Sure.
You might want to use like fuzzy matching because these product names are so close to each other.
Sure.
So when you use measure product effects, it might be helpful to use some name matching to get the right product effect. Yeah.
Sure, sounds good. But we are basically following these published papers. I think it's an econometrical paper by Khandelwal et al.
Right.
We're basically following their methodology where they use product code and the unit of measurement. But we can certainly improve on that. Okay. All right. So this is how we define.
I have one question. So it's related to UIC. So is UIC in nominal terms or is it in real terms?
It is, we do adjust for inflation. So you can think of it as real terms.
Okay. It's fair enough. Yeah. Because in case that's fair enough. Oh.
Yeah. But we have year fixed effects, and because these are in log, anything in the denominator should be basically absorbed by these year fixed effects. So I don't know if this is gonna, now you might have a more complicated story about across this industry inflation measures, which I don't know how to address. I think if we have the data, we can just control for that. But anyway, so what do? We study the correlation of UIC and firm level TFP, okay? We combine this data with Prof. This is gonna be useful because as you know, Prof has this unique feature. It has data on price and quantity of output sold, okay? And then this is going to be critical for measuring output quality as well, okay? So we are going to use a measure of output quality, and the fact that price and quantity data are available is going to be critical for that. And then we are going to study the following question. Does higher UIC correlate with firm level TFP? Okay. How about output quality? And then thirdly, what about durability? Okay, so I'm going to see if the correlations are there for this basic measure, for the way that we measure capital quality, okay? And then for the second part of the paper, we're going to use the staggered introduction of DRTs or debt recovery tribunals. What are these? These are basically a specialized course introduced across different states in India over time across at a staggered dates, and basically we are going to use this, okay? And this is basically not new. This has been used by several other published papers. And when we have to study the effect of DRT on debt and project costs, we want to understand whether companies that are located in states with DRTs, do they have more debt? What about the investment? These are things that have been documented in the previous literature as well. We find evidence consistent with the previous literature, and then we go to decompose this project cost to UIC, which is our measure of capital quality, and this additional capacity. Okay, so this is going to be, from here on, it's going to be what we find that has been not documented in the previous literature, and then we look at TFP and output quality. Okay, so basically that's sort of what this paper is going to do in the rest of the presentation. Okay, what do we find? We find that changing UIC from 25th percentile to 75th percentile is associated with 12% higher TFPR and 14% higher output quality. Let me pause here and put this magnitude into perspective. If you think of this association, so Bloom and Van Reenen in their famous QJE paper, they document that if you go from 25th percentile to 75th percentile of managerial quality, the productivity increases by 6%. Now what they're doing is a correlation. What we are doing here is a correlation as well. But what I wanted to highlight is that this magnitude is substantial. Okay, so a 12% increase in productivity if you go from 25th to 75th percentile of capital quality is substantial, and it suggests that there is something going on here. Okay, we also find that these correlations are stronger for industries with higher scope for quality differentiation. Okay, so think of it as if you're producing a smartphone, you really want to get higher quality capital, versus if you're producing bottled water, you probably want to get more of the capital rather than more low quality capital rather than getting fewer high quality capital, because there's just so much differentiation that you can do in a bottled water industry. Okay? So the first part of the paper is summarized with this following sentence. There is a substantial correlation of capital quality and productivity. Okay? What do we find in the second part of the paper? We find that firms in treated states, okay, increased borrowing and investment. Okay, so this is documented by previous literature. We find that basically these companies increase UIC, and capacity increase is basically marginal. Okay, so basically all the increased investment is coming from increased UIC, which is our measure of capital quality. Okay, so essentially these companies could borrow, they invested, and basically all of this investment is coming from investment in higher quality capital. Okay, we find that this investment increased TFP and output quality by about 4%. Okay? And we also find that the results are stronger in industries with higher scope for quality differentiation. Okay? So companies, as you would expect, companies that are investing in smartphone, they are more likely to increase UIC and less likely to increase capacity, versus if you're in bottled water industry, you're more likely to increase capacity and less likely to increase output quality, capital quality. Okay, and then we study several alternative explanations. You might have alternative explanations in mind. I'm going to talk about some of these alternative explanations, and overall, these alternative explanations are inconsistent with our findings, okay, or the channel that we are claiming that is driving the results, okay? And this is the punchline of this paper. Reduce financial constraint, increases capital quality and productivity. Okay, so that's what this paper is going to be about. Okay, all right. I want to summarize.
One question, Poorya, just before you. The other thing which I don't know if people can view it as exogenous instead of this staggered debt tribunals. I believe the database covers both private and public firms.
Sure.
So in a sense, I think there is an RFS paper which uses public versus private as exogenous. And so public firms have more access to funds than private firms, and therefore they're less financially constrained. So that might be an alternative way to look at financial constraints. But whether the endogeneity police will accept that, I'm not sure. But I think there's one paper which uses that in RFS.
I remember this paper, but I think for the point that we are trying to make, I think that would be an additional check that we can do. But the point that we are trying to make is referees don't give us a hard time on interpreting this as a reduced form of finance, a reduction in financial constraints. We don't care too much about what happens that the financial constraints of the firm is relaxed. But I agree with you. I think this is a nice check to have. Okay? All right. So
I have a related question. So maybe you will address it, or maybe you already have in your paper. So the question is, do you also see whether this relationship or the sensitivity of this relationship is more for standalone firms vis-a-vis group affiliated firms? Because,
we have.
Yeah, because there is literature which says that business groups have internal capital markets, and even if an individual firm is financially constrained, right, it can seek support from the group, and therefore, if high quality projects have high quality investments have higher NPV as compared to low quality investments, so it makes sense for group affiliated firms to invest in higher quality investments, even though they are financially constrained.
I agree. We do some of the standard checks in this literature, interacting with Rajan Singales and other measures of companies that are financially constrained versus not. And overall, the results support this notion that we have. But I agree with you. This is an additional layer of check that we can do. Yeah. Okay. So let me summarize the paper. These are the 4 figures that I think summarize the paper nicely. The first one is there's substantial variation in capital quality. Okay, so if you divide 75th percentile to 25th percentile of capital quality, you see that there is substantial variation. The second one is that this is no control. There's a positive correlation of UIC and TFT. Okay. So this is basically no control. We see that companies that use higher quality capital are more productive. 2 more correlations, and there was a question. There was a hand that was raised. I can answer the question. I don't know if there is a question still, but the third one is this one. Basically, there's a positive correlation between output quality and capital quality. And then the last figure basically shows a positive correlation of capital quality and company size. Okay, so basically, if you think of company size as a proxy for financial constraints, now I understand that this is not a perfect proxy for financial constraints. This is one way that people have been looking at financial constraints. So, companies that are larger use higher quality capital. Okay, so these are the 4 figures that basically summarize the main points of the paper. Okay, I'm going to proceed. I will assume that, was there a question? There was a hand that was raised. I couldn't see the name.
Professor Jayadev, I think. Yeah.
Okay. Okay.
Yeah. Can I ask? Yes.
Yes.
Yeah, the same question, I think Mr. Srini has asked it. Why that DRTCs is an exogenous in the case of financial constraints? Actually, the staggering starting of the DRTs in various states is various other aspects, because the government has not allotted appropriate budget for establishment of these courts. There was no adequate number of the judges available, legal personnel available to take up this DRT courts. There were so many government-related, legal ministry-related issues which are delayed the action of establishment of the DRTs rather than financial constraints. If I look from the supply side, actually banks have so many restrictions on funding of unlisted companies or private limited companies. As rightly pointed out, large firms may be having, or group firms may be having access to the debt, but other firms are facing various types of the issues. So those are the reasons for financial constraints.
Sure.
Banks have exposure norms. Banks have security norms. Banks have so many other type of the restrictions which firms are not able to meet the requirement of the banks. So banks have not extended the credit.
Sure. No. So I agree that these are all valid reasons for why companies are financial constraints. There's a constraint. Now I want to clarify something. So the DRTs that were introduced, I'm not claiming that DRTs were introduced across different states because the government has financial constraints. That's what I'm not claiming. So what I am claiming, however, is that the reason for why some states got DRTs earlier versus the other ones has nothing to do with the economic characteristics of those states. I think that's a claim that I'm making. Now,
I don't agree with that one. That is the fact is that one. The DRTs are established in that view. You may ask any policy maker from the why DRTs are staggered in this one. Do they expect that the firm state-related factors are responsible? It is the legal ministry. They don't have several things. The clearances have not been given by the state government for establishment of. There is no machinery available, legal machinery available. Okay, sorry, I made my point. Thank you.
Sorry. Okay. So what I'm gonna do, I'm gonna do the standard testing of these assumptions. One of the standard tests of this assumption is checking for pre-train. Okay. As long as the reason for differences in the differences of these establishments is not coming because companies in one state were doing well relative to companies in the other state, and this is the reason that these DRTs were established, I think the identification assumption is going to hold. I'm not claiming that it is random. I'm claiming that the reason that these establishments were delayed in some states relative to the other states has nothing to do with the economic conditions of those states. In other words, what I'm going to claim is that companies in these states companies in the states that don't have DRT, if you compare them with companies in the states that have DRT, they would have had been on a parallel trend. Okay? So that's the assumption that I really need. So if the companies that got DRT did not get DRT, they would more or less move in a similar pace as the companies located in the states that did not get DRT. That's the identification assumption, okay? And I agree with you that it's not obvious that this is going to be this is going to be true. I'm going to show you some evidence, and you tell me if this evidence is enough or you want more evidence. The other thing is that other people have convinced referees that at least this seems like an exogenous shock. But we can talk a little bit more about what you think or how I can test for your potential consent. Okay, right. So let me skip the literature review, talk a little bit about the data. So the data, I talked about the data, we use CAPEX, the data from 1994 to 2004. We use Prof, we link these two. There's a common identifier that we use to do the linking. I'm gonna skip an example of project and summary statistics, but you might be curious about how this data collected. Basically, this data is collected from annual firm report, media report, and so on and so forth. We had some concerns about data quality, so we did some checks about the data. I'm not going to go into the details, but essentially we check Prof with CAPEX, and basically we find evidence that the data quality is reasonable. Okay. So what we get from CAPEX is more or less similar from what we get from Prof. Okay, all right. So is the variation in UIC large? Okay, so this is the first question that we ask. This is important because there is a large literature that has shown that TFP is the variation in TFP or productivity is quite large across different firms. If we are claiming that variation in capital quality can explain variation in TFP, we expect this variation in capital quality to be large. This is what we find. Okay? So if you compare on average the company in 75th percentile to 25th percentile of capital quality, we see that on average, these companies pay 5 times more per unit of capital related to the companies in the 25th percentile. Okay. What is the regression specification that we use? We use the following regression specification. I just want to mention that we basically are comparing two companies' condition on investing. Not only that, we're comparing within the same narrowly defined product category. But this is not causal, this is just correlation. Companies with higher quality capital have higher TFP. We have 2 different measures of TFP. Okay, I don't want to get into the details of it, but I just wanted to mention that this is large. Okay? We do a bunch of other tests. For instance, TFP might not be your favorite measure of performance. We do other tests using different measures of performance. Okay. So this is another table. We try to understand why is it that companies that use higher quality capital have higher productivity. Okay. So we basically show that companies that use higher quality capital sell at a higher price. They produce higher quality output. I don't have time to get into the details of how I measure the quality of output, but we are using the standard measures from the literature. They have higher sales shares. Furthermore, the wage bill is these companies is lower, suggesting this capital and labor substitution, and they spend less on material. Okay, so basically, seems that once you get higher quality capital, you spend a little bit less on other factors of production. Okay. All right. We basically show these companies have higher exports. Maintenance is our measure of durability. We show that maintenance goes down. We do a bunch of other tests. I don't want to get into the details of why we do these tests, but essentially we find similar results using these other subsamples. Okay. All right. We study whether the correlations of TFP and output quality are higher for industries with a higher scope for quality differentiation. Okay, so this is the idea behind bottled water versus smartphone industry. Okay, how do we measure this scope for quality differentiation? We are using this measure by Sutton, and then this has been used by this previous literature as well. They basically measure a scope for quality differentiation by how much R&D you do plus advertising, and you divide this by sales. We basically find that the correlations are stronger if we use this measure of a scope for quality differentiation. So basically correlation with TFP, output quality, sales share are stronger in industries that have higher scope for quality differentiation. Okay. Not going to get into that, but basically we have a different measure of a scope. We use a different measure of a scope and we find consistent results. Okay, all right. So far, what is it that we have documented? We have documented that there is a large variation in UIC across companies. Okay? And we have documented that UIC and TFP are positively correlated and the correlation is substantial. Now you might be thinking, why is it that every company is not investing in higher UIC capital? If this is something good. We offer one potential explanation, and that's going to be financial constraint. Okay, we basically have a very simple model to show that what we are trying to show in this paper is actually consistent with a very simple model. Okay, if you have this very simple model with a few assumptions, you will get the empirical findings that I have shown you and I'm going to show. Okay, so that's part of the goal of the model. Okay, and then we are going to use this particular example, which is the DRT. We're going to look at the effect of DRT on capital quality and productivity. Okay, all right. Okay, so I'm going to talk a little bit about the context, but essentially banks and financial institutions face a high volume of non-performing loans, okay? And then the government of India decided to pass this act called the Recovery Tribunal Act in 1993 to address this high level of non-performing loans, okay? So the act established DRTs that are specialized tribunals to expedite the resolution of debt recovery cases. And then the pattern of the establishment was staggered. It means that it was introduced at different times across different states. We talked a little bit about that. And then it's basically the underlying law did not change, but the enforcement. Okay? And then the DRT, so previous literature has basically shown that DRT significantly reduce contract enforcement costs, okay? And we are going to use the argument that the previous literature was making is that this staggered introduction was due to legal challenges, okay? And this is going to be important for our purposes. Was the introduction exogenous to state level condition? And this is what we find. The time of establishment in different states was exogenous to average firm characteristics. This is not something that we only find. Other people who have done work in this particular setting have found the same things. Okay, right. So what do we find for DRT? Okay, so these states get these DRTs. Debt goes up. What is the idea behind that? The idea behind that is now the bank is located in a state where the recovery rate of loan is higher. As a result, lending becomes more profitable for these banks. They start lending more. Because they start lending more, companies in these states have more financing. Okay, so debt goes up, investment goes up, and this is the critical part for our paper. So project cost, which is another measure of capital expenditure, goes up, but almost all the increase in project cost is coming from increased investment in quality capital. Okay, so basically the companies that have reduced financial constraint increase investment in higher quality. They don't increase the capacity. Okay, so that's the empirical finding. That at least shows some evidence that this seems to be an important channel for companies, okay? All right, so increased, that goes up.
Can I interrupt a little bit here? Yeah. See, one thing you have to keep in mind about the sample period you have drawn, 94 to 2004, which I think in some way affects financial constraints, is this. The early 90s, 92, even 92, 93 was a huge IPO boom. Okay. And then what happened is a large number of companies came out, many of them were fraudulent. Okay. And then there was a big shock. I think SEBI stepped in. I don't know the institutional details so well. Mm-hmm. And then there was a big shock and the number of IPOs came down drastically. Right? Okay. So that could also be another to the extent these people are raising money, projects are being funded by equity markets. That's another shock that happened during your period. So just keep, I think 92, 93 was the big bubble. I don't know the exact time when the bubble burst in the Indian IPO market. But it certainly will have some kind of a ripple effect in terms of the SEO market and equity funding.
Sounds good. Yeah. I mean, we can take a look at that. Thank you. Okay. And then it increased because so basically project costs went up and then companies invested in higher quality capital. Okay. All right. I mean, I can show you evidence of a pretrend, but essentially we don't find evidence consistent with pretrend, and this has been documented in the previous literature as well. Okay? But I'm gonna skip it because I have a limited time. All right, so we do this decomposition of decomposing TFP to revenue and cost. We basically find similar results to before, okay? Basically, TFP goes up, price goes up, output quality goes up, sales goes up, and wage and material expense go down, but these are not significant. Okay. All right. We basically show similar results when we study the interaction with the scope for quality differentiation. Companies that are in industries like mobile, where they could differentiate their products more. They invested in quality of capital more. They increased investment in higher quality capital was more. And this is associated with increased productivity in those industries, higher price and higher output qualities. Okay? So this is what you would expect if you think that this is a reasonable way of capturing output quality, capital quality, and if you think that capital quality actually enables the production of higher quality art. Okay, we find similar results when we do this interaction with a different measure of a scope for quality differentiation. Okay, all right. So we have a bunch of results that are consistent with these effects being stronger in more constrained companies. Okay, so we use company size, sectoral leverage, Rajan-Zingral's measure of financial dependence, and small young companies, okay? Young versus old companies, okay? Right. Let me spend the last 5 to 6 minutes talking about alternative explanations, okay? So one alternative explanation, okay, so one alternative explanation that you might have is the following. Let me give you one alternative. It could be that TFP increased, so these companies became less constrained. TFP increased because they started doing more R&D. Okay, so that's one potential explanation. Okay, or they started training their employees more, or they started having more intangible investment. Okay, it has nothing to do with physical capital. These are all alternative explanations that you can come up. Okay. So we are going to directly test for this. Note that for the particular story that we have in mind, not only these should go up, but they should go up in a specific way. They should go up more for industries with higher scope for quality differentiation. Okay, if these are the underlying stories, and we are going to test for this. The second thing that we want to study, this is going to be related to one of the comments that was mentioned earlier, but I said I'm going to talk about it at the very end of the presentation. That's okay. So what about managerial quality? Why are you saying that the results cannot be explained by managerial quality? Maybe a company becomes less constrained. They hire a higher quality manager. This higher quality manager is actually the one that is increasing output quality and productivity. It has nothing to do with whether they bought high quality capital or not. These are the people who are doing this. So what we find, which is going to be this nice result, is we look at a company that is less constrained, okay, these DRT state companies. We look at these companies, but we look at the products for which they did not invest, okay? If our story is true, we shouldn't find anything in the products of the companies for which the company did not have an investment budget. Because if our story is true, we should find this capital quality, the output quality increase only in product categories that the company invested in and not in product categories that the company did not invest. This is what we find in the data, okay? So basically, if a company is less constrained, but they do not invest in higher quality capital in the product category, the quality of output does not increase in that product category. It only increases when you do an invest, okay? And then the second one is, there is an alternative explanation where basically physical capital sellers, okay? So a company, so let's say that there is a company that is selling machinery and equipment to a company in a DRT state. Maybe this company realizes, oh, they have more funds, so let me raise prices, okay? So the company that is selling capital goods is gonna raise prices. And because the way that we are measuring capital quality is through prices, we are basically seeing that capital quality, prices go up, but actually when prices go up, the benefits accrue to the company that is selling capital goods and not the company that's buying the capital goods, okay? If the story is true, we should expect the effects to be stronger in industries where there is less competition for sellers of capital goods, okay? And we are going to do the interactions and the evidence is not consistent with this story, okay? And then the last, Anil, yes.
Yeah, thanks for the response, Poorya. If
Sure.
I may just come back, I have an additional thought on that. So I was thinking, like you mentioned about the R&D scope, and then my concern here is that you know, the managerial quality could also drive the R&D scope in the firm, because it's not just for the product that is the focal product that you're looking at, but R&D is sort of an overall, you know, the investments in R&D are going to broaden the scope for all the products.
Okay, so your story, let me push your story a little bit harder. Your story has nothing to do with the particular product that the company is investing in. Your story is going to be true for other products as well, right?
Yeah.
But this is not the case, okay? So if I look at the companies located in DRT states, but I look at other products, this is not a product that the company invested in. The price, quality, and sales share does not go up. If the manager is benefiting every single product category, you should see this effect no matter whether the company invested in high quality capital or not. Okay, so up until this point, I was a bit skeptical about the paper, okay? But I think this is a very powerful test. This is inconsistent with a lot of other alternative explanations, okay? But feel free to push back on this.
Yeah, no, I think this table kind of clarifies, this explanation helps, because I think you tease out how it affects for different products differently. And
exactly. A lot of stories don't have a specific product market prediction. Our story has, okay? So this is a very powerful test to show that, look, other stories do not seem to explain this result, okay? All right. Let me skip. And then one last story is basically you might think about some general equilibrium effects kicking in. And it turns out that general equilibrium effects, basically we look at projects located in states where the state that the project is located did not get the DRT shock, but the firm headquarters of the firm headquarters state got the shock, okay? If our story is true, if it's about financing and it's not about this general equilibrium facts kicking in, we should expect to find results more or less consistent with what we are saying, even if the state that the project is located is not treated. This is what we find, okay? Yes, okay. So I think I am, okay, so I'm 7:30, I think I'm gonna finish on time. So basically, we define a proxy for quality of physical capital. We basically show correlation between firm level outcomes and this proxy for output quality. Most importantly, product quality, output quality, and TFP. And we basically show that reduced financial constraints increases the quality of physical capital and TFP. Okay, thank you so much for this opportunity. I don't know if there is more questions.
I have
I'm happy to stay more.
Yeah, so I have one live question. So how exhaustive is the coverage in CAPEX database? I mean, does it cover all kinds of investments, or is it only reported investments? Of course, I think you addressed this question partially in the beginning.
Yes.
Match with the Provis, right? Provis database.
So fair enough. So there is two questions. So I think the stated deadline is it should be that the stated condition is it should be more than 10 million Indian rupees. Okay, so a project is going to be covered if it's more than 10 million Indian rupees, which basically means that there will be a selection. Only larger projects are going to be covered. The second thing is that these should depend on companies actually reporting it. If the companies don't report it, Provis has no way of tracking, or if there's no trace record of what is going on, this cannot be true. Now you might, I have one answer. So this is how this is structured, but I think what you should be worried about is how much this is going to bias our results, right? So one test that we do, we have project costs from Provis, we have project costs from CAPEX, right? And project costs from Provis, what I'm talking about is, I'm talking about the way that people usually measure CAPEX, which is differences in PP&E after adjusting for depreciation, okay? So we basically run the same regression for the same subsample, we find the exact same result. So at least it seems that even if you don't believe full reporting, because of the nature of the shock, you should have a particular story about somehow these states that got the DRT are differentially reporting relative to the states that did not get the DRT. So, you know, once you have these exogenous shock, your story should get a bit more complicated. But anyway, we do this test and we find basically the identical results, okay? And one other thing that I want to mention is that, so we are, one other source of bias, I didn't get into the detail, but it's in the paper. We are only including company years for which the company is making an investment. It turns out, so this is introducing two levels of biases. Level one bias is we are not looking at the company, the years in which the company is not investing. And on top of that, we are excluding other firms that don't have the investment project, okay? This turns out not to be a big source of bias. So if you put in everything else, and if you compare the magnitude with this, our magnitude is 80% of this magnitude where you put in full data, okay? So, and this is consistent with this literature that basically says that firms do lumpy investments, okay? So most of the times firms are not doing anything. They invest, when they invest, they make a big investment, okay? So that's more or less where this is coming from, okay?
Okay, thank you.
Sorry for the long answer.
Yeah, any other questions? Okay, it seems like we don't have any other questions.
Okay, great.
Yeah, thank you everyone for participating and listening. And it was an insightful talk, and we also had several thought-provoking questions. Maybe we'll have an in-person seminar by Poorya whenever he's in India next time. So on this note, we'll end today's seminar, and thank you everyone once again for joining us.
Thank you so much for the invitation, and I enjoyed talking and interacting with everyone.
Thank you, Poorya. Nice paper.
Thank you. Thank you. Thank you so much.